Long-term patient equity investors have historically been rewarded for allocating a portion of their portfolio to emerging market regions. However, this return premium has come with greater levels of volatility or price fluctuation risk when compared to investment in developed market regions. Over the last 3 decades, markets have seen pronounced and long-lasting cycles in the leadership between emerging and developed markets, with the most recent phase notably favouring that of more developed regions. Emerging market returns dominated that of their developed market peers from the mid to late 1980s up until the mid-1990s, when challenges started to be seen, culminating in the Asian financial crisis in 1997. Developed markets then outperformed in the next period, up until the bursting of the dot-com bubble in the year 2000. Emerging markets then, in the next phase, rebounded strongly in the 2000s, until the seismic effect of the global financial crisis ushered in another period of developed market relative dominance, which has persisted with only brief interruptions to the present day. The underperformance of emerging markets over the last decade has occurred despite the fact that the region's share of global gross domestic product, or GDP, has significantly increased over this period. This has caused the gap between the region's share of global market capitalisation and its share of the global economy to widen. Whilst emerging market indices contain a huge variety of very different economies with differing political regimes and performance drivers, and they are perhaps still too often viewed under a single lens within the investment community. However, looking at an aggregate index level, the emerging markets trade on one of the widest valuation discounts to developed markets seen over the last 3 decades. And with developed markets navigating a notable change in the backdrop for inflation and interest rates, a more compelling case for higher emerging market allocations is bearing its head in our view. And so today, we look at a highly differentiated strategy searching for compelling opportunities within the emerging regions. Hello and welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on the topical issues of today. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details of the unique ways in which we do that on our website, killik.com. In today's episode, we speak to Charles Jillings, Chief Executive of ICM Investment Management Limited, which has the management agreement to run the London-listed UK investment trust, Utilico Emerging Markets, ticker UEM. Utilico Emerging Markets has a highly differentiated investment approach which sees it focus primarily on sectors such as infrastructure and utilities. Holdings are generally cash generative, operational businesses which have some form of asset backing, with the focus being on the infrastructure assets themselves rather than the users, with the example being airports rather than airlines. These businesses are generally enablers and beneficiaries of economic development in their respective markets. The assets are often long-term in nature and operate in established regulatory frameworks, offering some degree of predictability and sustainability of income, which is borne out in the long-term return profile of the strategy and evidenced in the above-market income yield offered by the shares. In our view, infrastructure investments play to some of the most significant structural trends underway within global economies today, whether that be in the energy transition, digitalisation, or in the changes in global trade patterns. And this is no more true than in emerging markets. We view UEM as providing a unique way of gaining exposure to the emerging market investment story and highly complementary to other more traditional strategies, some of which we've already featured on previous episodes of the Investor Insights series. UEM is also a trust which has been impacted by share price discount widening over the last 2 years, a feature which has been prevalent across many London-listed investment companies, as weak sentiment towards UK listed investments in general, seen in the persistent fund outflows from the country, in addition to more specific issues to the investment trust sector, such as burdensome cost disclosure rules, has led to a number of investors paring back allocations to these specific companies. At the time of record, the shares of UEM trade on a 16% discount to the prevailing net asset value, representing a level at the very bottom end of the typical trading range for the trust, which is also buying back shares into this discount regularly. Hi Charles, good afternoon. How are you doing today?
Hi Gordon, very well, thank you.
So our kind of standard opening question to kind of start these discussions has been one that attempts to get a bit of an insight into you and kind of what you've been working on recently. So I wondered if there are any kind of interesting articles or books that you've been reading recently, or just a kind of anecdote from a recent meeting, anything you can share?
Certainly. So I'm an average reader, I think around three topics. One is health, one is, if you want, trade and how empires have grown and developed, and the other one's gardening. I love gardening. But the one I thought I'd pick out was one I read last year called Oceans of Grain, which is a book written by Scott Nelson, which is looking at the evolution, if you want, of the wheat trade globally. And wheat used to dominate Central Europe. And over time, due to plagues, due to better outcomes, if you want, in terms of farmer production, it shifted. And it was fascinating to read, if you want, how that shift went from sort of central distribution to ports to, if you want, Constantinople, and eventually to America, which dominated wheat around the 1860s onwards. And what unlocked it in America is the railroads and the ability to transport wheat at a cost that was highly competitive. And, you know, I just look at that and I read across to the emerging markets. And it's fascinating to see how, if you can establish the routes of trade and you can drive efficiencies into them, then you can properly see your volumes grow. And that's certainly something that I see in the emerging markets.
Yeah, no, very interesting. Yeah, we might bring the discussion back round to global trade in a couple of questions or two, kind of back to the kind of present day, very topical. So as I kind of briefly alluded in the intro, I mean the UEM portfolio, I mean, it does look very different to the kind of traditional emerging market fund. You're very deliberately focusing on specific areas, largely related to infrastructure assets. I wondered, just as a kind of intro question, and to perhaps provide some listeners that may be less familiar with the approach, just kind of, could you maybe briefly describe those characteristics that you're looking for when you're looking for a potential investment? What are the commonalities between investments that you're looking at?
So I think the common theme through the middle of our portfolio, which is focused on utilities and infrastructure, so things like airports, toll roads, transmission lines, data centers, the real sort of guts of a functioning economy. We are focused on outstanding asset opportunity, but also finding very strong, capable management teams that understand how to out the value. I've seen any number of good assets destroyed by poor management decisions. So we need to find a good asset, good management team, and then we need to understand what are the drivers that will deliver the growth and therefore the uplift in valuation, not over a day or a week, but over a year to 5 years. We are long duration investors looking for compelling investments. And I often say, I want to see them double in 5 years' time. What can drive that sort of outcome? And I think the other thing to really note for listeners is over 95% of our portfolio is listed. So we're invested in in companies that are on the stock exchanges across the emerging markets. And over 95% is operational. So what does that mean? It means that they own an airport. They already have a runway, say, and one terminal. They might well be adding a terminal, but they can demonstrate to us their knowledge and skill at operating that asset that they already have. And what's that lead to? I sometimes think our top investment that's been top of the portfolio for nearly since day one, International Container Terminal, demonstrates that in spades. This is a port operator with over 30 ports across the globe in 20 countries. And their real strength as a management team is just discipline and execution. And they are constantly driving for improved margins. But why have they remained in the portfolio over that duration of time? They constantly add new terminals to their portfolio. Very often they have pretty poor metrics when they bring them on board, but 3, 4, 5 years later, those metrics are starting to achieve what the management team does with an existing port. And you can see the value of that opportunity drop to the bottom line. So if I gave you ICT's quarterly results for the first quarter this year, their revenues were up 11%. Their EBITDA was up 18%. And why is that? Every additional container doesn't cost them a lot to service, and therefore it drops through to the EBITDA line, which is what we would expect when it dropped through to an EPS growth of 23%. So your strong metrics. And once these companies hit their stride, it should be deliverable over an extended period of time. And if you look at the valuation metrics that we're expecting the EBITDA multiple to halve over the next 5 years, which is just telling me this is an investment we should hold.
Yeah, thank you for that. A good example of the types of growth you can get from these sorts of businesses. One thing that comes across is an important part of the process is kind of getting boots on the ground and actually going out and visiting these assets and kind of key stakeholders. And I understand you've not long returned from what is, I think, a kind of regular trip to Latin America. So I wondered if I could ask you for kind of any takeaways from that trip, and maybe if I was to kind of lead you to one area, it would be Mexico, just because that's kind of a country which is obviously received quite a bit of attention recently, kind of going back to that global trade theme as kind of being a beneficiary of kind of these changing global supply chains that we're seeing kind of post-COVID and post kind of those tensions in global trade. I wonder if there are any kind of takeaways from that visit.
There certainly were, and as you know, we visit Latin America in March, April every year, and we've been going for close on 18 years. And every trip I come back with more energy, more insight than the last trip, and all that tells me is these economies are making proper progress. And if I look at, I went to Brazil, Colombia, and Mexico. If I just try and characterize, Brazil quickly before touching on Mexico. Brazil is an economy that I think's reached a tipping point. If you look at it, they've invested very heavily to unlock, if you want, their commodity resource, which is their key asset. So, everything from iron ore and oil through to soya, coffee, and their terms of trade, the balance of trade in 2022 was positive 62 billion. Last year it was positive 92 billion, and this year looks as though it'll grow again. And all that's telling me is actually they've reached a point where they are properly unlocking the resource. And looking forward, just out of interest, the one commodity that is coming online really, really strongly is oil, where they've got offshore exploration, which is going to deliver very strong growth. And all of that is enabling the economy, I think, to function at a much higher level, and therefore give investors more confidence that we aren't, if you wanted that break-even point, we're beyond break-even, and we can be pretty confident about ports and toll roads and rail. Mexico's different. Mexico, I came away with a real high conviction that their engagement with the US economy is deepening and accelerating at a pace that I've not seen anywhere else. You hear lots of things talked about, you hear lots of things articulated, but if you went to, as we did, to Mexico City, and you go and see logistics centers, and these are big warehouse operations, they're 100% full. In fact, the capacity that's coming online is already booked. And if you want, we've got an asset in Eastern Europe, and that's running at about 92, 93, 94% occupancy. Here we have Mexico running at over 100%. It's extraordinary to see. And the rest of the infrastructure that's being built in order to enable cross-border trade to accelerate is impressive and understandable. Mexico's 110 million people, right side in terms of demographics, right side in terms of work ethic, and they can support nearshoring and shortening of supply chains, which are two big drivers for US industrial base. No doubt the friction between China and the US has caused it, if you want to accelerate. But I think looking forward, it should remain a driver for the next 5 to 10 years.
I mean, you mentioned Brazil. I wonder if I could quiz you a bit more on Brazil, because I mean, if you look at the kind of current Utilico portfolio, I mean, you do get kind of notable exposure to Brazil, and I know you're not looking at things in terms of wanting X% here and X% there, but it is a notable allocation. I wonder if you can maybe just explain some of the opportunities that you're finding in Brazil. What types of businesses you're actually invested in there?
And so, just to emphasize, we are bottom up. So Brazil's been, since 2005, I think Brazil's been as high as 30% and as low as 10 or 8. And if we can't find something, then we can't find something. I think Brazil in particular at the moment is benefiting from a number of assets which have performed. So there's no doubt the last 12 months has seen really strong performance from those assets in terms of their business metrics. We've also seen them rise in valuation, although I would argue they're still cheap. But I think they are, businesses like Rumo, which is a railway operator. What's the most exciting thing about them? They can double their capacity by extending the trains, by, if you want, good management of a train infrastructure asset. And if they can do that, then, the returns are exciting. And looking at, if you want, their main commodity that they transship, which is soya, that's growing and well beyond anything that they can service. So, but things from that through to the Santos port outside Sao Paulo, which is doing extraordinarily well. And we're seeing, volumes in these ports pick up materially, and their ability to negotiate contracts with shipping lines have strengthened. I think other businesses that we have there, Alupar, which I've always sort of said is a forever investment. This is a well-run, well-managed private family infrastructure asset investor listed in Sao Paulo, but they deliver compound growth year in, year out, and they constantly add new assets to their asset base, and They're very disciplined. They won't overbid for something. But when they win, they will execute cheaper, execute quicker, make better returns. It's a fabulous business. And it's, if you want supply, it's paid for uptime. So as long as the transmission lines are up and available, they get remunerated. And, their, if you want, contract is inflation adjusted. So protected from all the headwinds sometimes of inflation.
Thank you for those examples. And my next question is involving valuations at the moment. We've spoken on the kind of this series of discussions a lot about the kind of the dispersion in valuation multiples in markets generally, and previously we kind of discussed things like UK versus the rest of the world, or versus the US, or small caps versus the kind of magnificent seven, or large caps. But the dispersion of valuations is quite noticeable in emerging markets as well at the moment. You only have to look at kind of the Indian market and the Chinese market, for example, and the kind of dispersion in returns and valuations of those markets. But I wondered, kind of specifically for your kind of investable universe, how are you viewing valuations in the context of history for kind of your subset of investments?
I think generally emerging market valuations are below, their long-term trends. Why is that? I think as with the rest of the developed world, interest rates are high in the local market. Local investors are investing in bonds, which is the right thing to be doing at this point in time. The equity markets are somewhat unloved. So we would argue valuations haven't caught up with the performance at the moment. But it's true that you get disparities between markets. And I think the way I rationalize it is India always trades at a premium to most of the rest of the markets. And as long as you accept on the way in, you may pay a little bit more, or on the way out, you probably get paid a little bit more as well. China, I think, is fascinating. It's still a huge economy and one we do need to pay attention to. And it's undoubtedly cheap. I think my question mark is what's going to change to drive that economy? And we do need to see a stronger or functioning property sector. We do need to see an engaged consumer. And at the moment, I think the Chinese government is doing enough to keep stability, but not enable growth. So our Chinese investments are down around 10%. I suspect they stay there until we can see there is either enough impetus for change or a step change happens. But undoubtedly, they're cheap.
My next question is around kind of political risk, and again, very much emphasising that you're kind of bottom-up investors, but we kind of came into this year knowing that it was a big one for elections around the world, and some of them have kind of been and gone already, but there are notable ones in the kind of second half of this year as well. I just wondered how your approach, how you approach kind of navigating a year like this when you have got potential for kind of governance change around the world, and that may impact some of these investments.
So I think the interesting thing is, if you looked at most of the economies we're invested in where there is change, either taking place or about to be or take place, the incoming administration is likely to be following the outgoing administration. So if you look at Mexico, Lula's favored candidate, I think, is 20% up in the polls at the moment. She should get elected, and there's no reason to expect her to change what's been a relatively successful economic policy by Mexico. If I look at India, where the elections are underway, we think Modi will win, and Modi's economic policies have been about unlocking the economy, so enabling infrastructure to unlock the economy, and we can't see why that will change. If we look at Indonesia, change of government already happened. Again, we don't think there'll be a lot of change to, if you want, the economic policy and strategy. So we're probably positive, and for one massive reason, that most governments still understand and are still focused on the infrastructure, be they the Philippines, Indonesia, India, Brazil, Mexico, and therefore the opportunities are actually wider than they've been for some time. I think the big election we keep focusing in on is the US and exactly how they position themselves, because they are the biggest economy in the world, and you need to pay attention to how they position themselves. But if I come back to Latin America, Mexico, 110 million people, good relationship with America economically. A lot of them work in America and send funds back. Cheap labor force growing, and Brazil, 200 million people, lots of, if you want, commodities, soft and hard, and taken a very neutral line. So should be, following the tailwind of America. But I think we do need to pay attention to what comes with the US elections.
Absolutely. I think that point of kind of focusing on assets which are very critical to the running of an economy is a kind of key one, regardless of the kind of the governing party at the time. Charles, our final question is one we ask everyone. It's one that asks you for your kind of highest conviction area at the minute. And you've mentioned a fair few companies as we've gone through already, but I wondered if there was one particular area or company that you're particularly positive on at the moment that you'd highlight.
I think Latin America is a simple answer. I think they've got themselves lined up in terms of capability, and what they're offering is in demand. Therefore, I bet on Latin America at the moment.
Yeah, good stuff. Yeah, no, thank you for that. And Charles, thanks for your time again. We really appreciate it. Always interesting to chat to you. Thank you.
Thank you, Gordon.
Thank you for listening to the Investor Insights podcast. You can contact info@killik.com, referencing the podcast for more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority, the FCA.